Oh, well, thank you. It's a pleasure to be back again. I didn't think I'd be back this year, primarily because 2 years ago, when I came, the market fell 850 points. And then last year when I came, you had your tropical storm. So I figured I was pretty well done for coming to Pensacola. So again, thank you for having me back. Actually, maybe my luck has turned today. Anybody know what the stock market did today? It's up 250 points, so you're welcome on that. One of the things about coming back and speaking to a group where you've been before, and unfortunately for people like me where they tape where you were before, is you can play my talk out on YouTube and some websites from the previous two talks. What I thought I would do, though, is Billy was kind enough here at IHMC, and by the way, thank you very much, IHMC, for having me back, to splice together some things that I said last year. If anybody was here last year, I did something similar, but that was kind of a goofy thing. This is actually what I said last year during the talk, and you can kind of get a gist for what we talked about and how well I did. So let's see if I can do this right here. As Carol mentioned, I was here last year, and the market promptly fell 850 points. I came this year, and you promptly had a tropical storm. I won't come next year, I can pretty well guarantee that. So, if somebody asks me, where do I think this market can go in the short run, I think a kind of a good upper limit to be using from an investor standpoint is probably somewhere around the 11,000 level. It's not the worst thing you've ever seen. Interest rates, clearly bullish right now. Are they going to be going up? I'm in the camp that they're not going to be going up significantly anytime soon. I think that the Fed is very fearful of the economy. I think it's very fearful of raising the rates too quickly. I think there is somewhat of a mentality of trying to inflate our way out of these things. So I don't think interest rates are going to be a problem from the market standpoint. Inflation is one of those things, 10 people could argue, and 5 of them could say, boy, inflation's going to take off, and 5 could say, I don't think so, at least not for the next 12 months. I'm probably in the latter camp. Yeah, I know we're dumping money into the market, into the economy in a big way. Yeah, I know the dollar is just going to heck. Yeah, I know all those things. Gold is going up, all those things that would really point to inflation. And that may happen, but I don't think it's going to happen over the next 12 months. I don't think inflation is the real bogeyman here. And the thing that I'm not seeing that I usually need to see for me to get too fired up about inflation is really wage pressure, where you start really seeing wage inflation there. And I don't know about Pensacola, but I'm not seeing that up outside of Chicago. So I'm not too concerned about inflation. I know there are a lot of people that are. I know they can make really good cases why you should be, but I just don't think inflation is really what's going to short-circuit this market. We're probably in an area here where if the market really pulled back dramatically, and what would be dramatically? I think a pullback of 1,500 points from where we are now is very possible, okay? Very possible. Would that be the worst thing in the world? Nobody would want to see a pullback 1,500 points. Do I think those March lows have a chance of being approached at 6,500? I don't. Some stocks that we are currently recommending right now that score extremely well in Quadrix and we feel offer some interesting opportunities. We have pretty significant overweightings right now in both technology stocks as well as healthcare stocks. One is AmerisourceBergen. AmerisourceBergen, the symbol is A, B as in boy, C. A second healthcare stock that we like is a company called Hospira. That company is Novo Nordisk. A couple other stocks in that technology area. I like IBM. I also kind of like Microsoft. I'm always hesitant to mention Microsoft in kind of a technology place because nobody seems to like Microsoft, but I do right now. So just to kind of give you an overview of that, remember last year I was here and I think the date was November 12th. So we were right around here. The Dow was at about 10,200. So I said maybe best case 11,000. Actually, I was off a little bit. It was 11,205 in April. And then I said, 1,500 points wouldn't surprise me. We went from 11,205 down to 96.86, which is about 1,500 points. In terms of the stock recommendations, the first one I mentioned was AmerisourceBergen. Since November 12th, that stock is up 29%. Hospira is up 19%. Novo Nordisk is up 53%. IBM's up 12%, and Microsoft is down 14%. So apparently the technologist knew something I don't on that. Just to wrap this up, those stocks I mentioned, AmerisourceBergen, ABC, is a stock we still like and recommend. Hospira is a stock that we have sold, HSP, so we no longer like that stock. Novo Nordisk, which is a stock I'll talk about a little bit later, is a stock I still like. It's up 53% since November 12th of last year, and it's a stock that I like, and I'll talk about it. Novo Nordisk, that name may not mean anything to a lot of people in the room, but I can guarantee you their product sure does. They're the largest provider of diabetes treatment products in the world. IBM, we still like, and Microsoft, I'm still hanging in there with Microsoft. You may be wondering where I came up with 11,000 last year, where I thought that might be the peak. And no, it wasn't a number I, pulled out of thin air. One of the tools that my firm uses to try to divine the market and at least say what the market's primary trend is something called the Dow Theory. I wear a bunch of different hats. I'm the CEO of Horizon Investment Services, which manages money for individuals, and I'm also CEO of Horizon Publishing. That name may not mean much to anybody here, but that our product might be familiar. We publish investment newsletters, and one of the investment newsletters we publish is a newsletter called Dow Theory Forecasts, which has been around since 1946, and is actually one of the oldest newsletters still published today. I've been there since 1982, so I'm a rarity. It's the only place I've ever worked. I've been there for 28 years. The Dow Theory Forecast, obviously, hence the name Dow Theory, uses the Dow Theory to divine the market. The Dow Theory is a tool that was developed by Charles Dow, the first publisher of the Wall Street Journal back in the 1890s. And the Dow Theory I have found to be the single best tool for giving me some idea of the market's primary trend. That is, the trend that tends to last 18 to 24 months or longer. The Dow Theory doesn't necessarily tell you how high a market's going to go or how low a market's going to go. In terms when it's in one of these either bullish or bearish trends, but it confirms whether the trend is bullish or bearish. And the Dow Theory tends to be pretty specific when it maps out patterns in the stock market. For example, the Dow Jones Industrial Average peaked at around 14,000 back in 2007, and that's a number worth keeping in mind. We've had a tremendous move in the stock market since March of 2009. The market's gone from 6,500 up to about 11,000. Actually, today it's 11,255 after the market moved today. Big move in the market. Yet, even with a market that's gone up 60% or so, we're still 25 to 30% from that 2007 peak. And that's worth keeping in mind as I talk about risk in the market and whether I think this is a risky market. So we had a peak here. The Dow promptly, and I know this is going to bring back bad flashbacks, and it's going to cause some of you to go out and get more to drink, but it went from 14,200 down to 6,500 in March of 2009. So you had to fall somewhere in the 7,000 points, 7,500 point range. If you go from this May high, the market got cut in half. That's pretty remarkable if you remember that. Right here, the market was about 13,000. In less than probably about 10 months, it lost 50% of its value. Well, the Dow Theory says after a decline of that magnitude, typically you're going to get a retracement of about 1/3 to 2/3 of that previous move. And this is where I came up with the 11,000 we were talking about last year, because remember, I made this comment right about here. So we had a move. Let's say this was a decline of about 6,500 to 7,000 points. A 2/3 retracement of that, which would be the maximum retracement, would be about 4,500 points. So from 6,500 being the low here, you add 4,500 points and you get to about 11,000. So that's kind of where that came from. It was just following purely what the Dow theory tends to say about market reactions like that. And you saw a similar one, which is very important under the Dow theory, in the Dow transports, because the Dow theory looks at the performance of the Dow Jones Transportation Average and the Dow Jones Industrial Average, and from the movement of those two averages together, it says whether the market's primary trend is bullish or bearish. You might be looking at this saying, well, this is just a bunch of charts. Well, there's actually a fundamental basis underlying the Dow theory, and it basically is very simple. Charles Dow said, listen, the industrials make stuff, and the transport ships stuff, and for an economy to truly be in sync, and therefore, hopefully corporate profits to be rising and so forth, you need these things moving in synchronization, in sync. And you certainly had it in sync on the downside, confirming this horrible trend here. And then you had similar moves, 2/3 rallies in both the industrials and the transports. Now, the other reason why I said I thought the market could potentially drop 1,500 points, again, was based on Dow theory analysis. It wasn't pulling a number out of thin air, excuse me. This move here, being about 4,500 points, the Dow theory says you can have a retracement of 1/3 to 2/3 of that move. So a 1/3 pullback there was right around here, 1,500 points. It was possible we could have had a 2/3 retracement and gotten down to here, but at the time I just didn't think that the market was going to get down here at this point. I had just felt that these lows were just so crazy from an overreaction and a selling climax and everything that we weren't going to get that low. So that's where these lows, that's kind of where I thought 1,500 points would come down. So I was really using the Dow theory. So what's the Dow theory saying about the market right now? And how does that apply to the risk in the market? Well, fortunately, after the pullback you had in both the Dow Industrials, this was from April to, the industrials peaked in late April, and this was July 2nd. The transports peaked, I think it was May 1st, and this was the July 2nd low. After this move, what happened? And this was a very bullish indication under the Dow theory. You had both averages go back and surpass their previous highs. In the case of the industrials, we got up to about 11,400. And the transports were pushing 5,000 now. The fact that we had a rally, had a pullback that was significant under the Dow theory in both the Dow Industrials and transports, and then had a subsequent resumption of the upward trend that surpassed these previous highs, that under the Dow theory is a very bullish indication. So the Dow theory right now is saying this is a bull market. And I kind of think it's a bull market, to tell you the truth. I know there's a lot of people in here. How many people think the market's destined to go higher from here, significantly higher? Pretty uneven, right? Pretty uneven in terms of a mixed crowd. A lot of people think that the market's probably not going to go much higher from here, and they point to the litany of all the stuff that's out there. You've got a European meltdown. You've got, no progress on employment. You still have, political uncertainty. We don't even know if tax rates are going to continue next year. All those things out there. And yet you have a market that's kind of, at least in my book, saying, you know what? I think this thing can move higher. I like the fact that we have a market situation that doesn't have a consensus, because to me that's the type of kind of fertile ground that you get sustained moves in the market. And there isn't anybody talking about a sustained multi-year move in the market anymore. What everybody's doing is what people tend to do. We tend to anchor in terms of when we're trying to project the future. What do? You take what's happened in the recent past and extend it out. And so we've had 10 years of a pretty lousy market, really. And so are we going to get another 10 years of that? A lot of people think so. I happen to think we're not. We'll have to wait and see. So the Dow theory here basically is saying, look, this is mapped out, pretty classic Dow theory analysis. We've had everything we needed under the Dow theory, and we eclipse those previous highs. That under the Dow theory is a bull market. So we'll have to see how that goes. So when I get back, and the topic here is how risky is this market, at least from the Dow theory perspective. And again, looking at the primary trend, which tends to last 18 to 24 months, The market's saying, the biggest risk right now, if you're willing to look over the next 18 to 24 months, is not so much being in the market, but is probably being out of the market right now. Now, having said that, stock markets don't go up without breathers. And in fact, the interesting thing is, some people go, well, Chuck, if this is so smart, it's almost like the minute they got through these previous highs, what'd the market do? Well, it came back down. So you got this confirmed bull market signal, and then all of a sudden the market, after it gave that, came right back down to around 11,000. That's not unusual. In fact, I see that happen more often than not, where you've had a market go through and kind of work its way to get through previous resistance levels like this, and finally when it does punch through, it takes a lot of energy to do that, and then it takes a breather, so the market pulls back. The nice thing about that is, on pullbacks in here, at least from a Dow Theory perspective, you can buy these pullbacks, in our opinion, based on the fact that the primary trend is bullish, that you're not buying into a bear market, that you're buying into a pullback within a bull market. So again, it's not unusual for markets to kind of break through those points and then, they have to take a breather and then come back down. And there's certainly a lot of kind of daily risk in the marketplace right now where you're going to get some volatility. We're getting to the end of the year. You've got North Korea lobbing stuff at South Korea, and you've got a lot of kind of exogenous factors in there that can create a lot of kind of daily volatility. But at the end of the day, at least based on this tool, the primary trend is bullish. Pullbacks in here, I think, represent opportunities to add to portfolios, not sell. Now, having said that, markets don't move straight up. They are punctuated by pullbacks. And it's not surprising, if your investment time horizon is 2 or 3 months, getting back to this notion of how risky is this market, I think it's much more riskier for you if you're really looking out 2 or 3 months than if you're looking out 12 to 18 months. And one of the reasons for that is this chart. Now, I talked about this chart the last 2 times I'm here, and I'm going to talk about it tonight, not because I don't have stuff I can talk about, but this is the single best tool I have ever seen for giving me some snapshot of market risk on a shorter term basis, say over the next 3 months or so. I'll explain in a minute. It looks like a bunch of kind of gobbledygook. As I said last time, it looks like the EKG of people during 2008. Certainly was mine during 2008. This tool, my firm calls it the Intermediate Potential Risk Indicator. It's the name we have given this. You're not going to find this anywhere else called this. It's just what my firm calls it. We've been tracking this indicator since 1989. What I like about indicators like this, it's very simple and it's very inexpensive. And I'll show you how you can get this very indicator and the one data point that you need to look at for the price of a daily newspaper here in a minute. So it's very simple, very easy, depends on one data point, yet it's the single most powerful tool I've ever seen in 28 years for giving me some perspective of short-term market risk. Long-term, I think this market risk is pretty minimal, really. Short-term, risk is a bit higher, and here's why. Basically, this chart looks at one data point and one data point only, the percentage of stocks on the New York Stock Exchange that trade above their 200-day moving average. The percentage of stocks on the New York Stock Exchange that trade above their 200-day moving average. That sounds like a lot of kind of a mumbo-jumbo. What is that, Chuck? And why does a 200-day moving average matter? Well, I'm kind of a believer in the math concept of reversion to the mean that says, in the short run, things can kind of run to extremes. Think weather, and I don't have to tell you guys about weather. You can have hurricanes and tropical storms in the short run, but over the long run, your weather patterns are usually at some equilibrium level, some steady state, some kind of golden mean. Why? Well, it takes too much energy to sustain the extremes. That energy dissipates, and we come back to kind of an equilibrium level. Think human emotions, where births and deaths and job losses and weddings and so forth. And your emotions spike, but we don't live our lives at those extremes. At least most of us don't live our lives at those extremes. Why? We'd be exhausted. Okay? The energy that drives it dissipates, and we kind of live our lives at some kind of equilibrium, golden mean. I think there's a similar relationship when it comes to stock prices. we certainly have seen stock prices spike on short term. I mean, 2009, March, selling, tremendous amounts of selling, pounding down stocks. I mean, that was an outlier in terms of the energy that it took to drive stocks lower and the amount of selling that was going in to do that. But as that selling subsided, what did we see then after March of 2009? The market kind of came back up. This is a good measure for trying to get a sense of where stocks are on that spectrum of are they spiking higher or are they spiking lower in terms of popularity with investors. I think a stock's 200-day moving average is a reasonably good proxy for a stock's equilibrium range. It's not perfect, but it's a pretty good proxy because to get a 200-day moving average line, what do you need? Well, you need 200 trading days. You take the average, that's a point on the line. To get the next point, you drop a day and add a day, point. So when you look at a 200-day moving average, that encompasses a fairly wide period of time. Now, equilibrium ranges don't have to be flat line, and typically they tend to move upward because stocks over time, although it hasn't felt like it in the last 10 years, but stocks typically over time tend to trend higher. So you'll see typically 200-day moving averages that have a slight upward bent to them. But if you're looking for kind of a proxy for a stock's equilibrium price level, I think a 200-day moving average works as well as anything. So what this says is basically it gives you an idea of the percentage of stocks on the New York Stock Exchange that are trading above this equilibrium level. And the thinking is if you have lots and lots and lots of stocks on the New York Stock Exchange that are trading above their equilibrium level, at some point you would expect them to start to migrate back down toward that equilibrium level, coming back down. Conversely, when you have very few stocks trading above their 200-day, and if you flip that, that means lots and lots of stocks trading below that equilibrium level, you would expect at some point that they'll start to migrate upward. It doesn't have to happen immediately. And we've seen, extremes can run longer than we think. But it gives you some idea, some perspective at a point in time in terms of giving you some relative comparison to where we are. So, if you go back to 2001, you can see that this percentage, and by the way, my firm has quantified lots and lots and lots and little by saying, look, when you get 40% or fewer stocks trading above their 200-day moving average, we classify that as kind of lower risk in the market. Conversely, when you have 70% or more of the stocks trading above their 200-day moving average, we kind of consider that more higher risk in the market. And again, short term, I'm talking about, say, 3 months. If you go back now to 2001, this got down right around 20%. It actually got about 19%. Which at that time was the lowest it had ever gotten in the years we were tracking it since 1989. Does anybody want to guess what happened to drive it down? It was 9/11. It was 9/11. So, here you had an instance when you had 9/11, markets closed. They opened up, 3 days later? And when they opened up, what happened? Boom. And you had this. Now, hindsight being 2020, stocks were pretty far out of favor right here, which means it probably wouldn't have been a bad time to pick up some stocks. Now, I know it's never the easiest to be a buyer of stocks during that type of market environment, okay? That's tough. I get that. And that's why it's always nice to have within your arsenal of investments investment tools that force you to do something, even at times when you don't want to. That's why I'm kind of a fan of dividend reinvestment plans. One of the really underrated value of having a dividend reinvestment plan is that forced buying with the dividend that comes due that you're reinvesting. Because for some people, I can guarantee you, for most of investors, the only buying they're doing here, they're not doing it out of their own volition. They're not waking up and going, all right, time to buy. They're freaked out. So if you have dividends that are automatically reinvesting for you, at least you're getting some skin in the game during a market period when your brain says you really should do it, but your heart and everything else says there's no chance. So, had you bought here, what happened? Well, you had a nice little rally into 2002, and then what happened? Bottom fell out. Remember, the second half of 2002 was terrible. So, right now, had you bought, you feel pretty dumb. But then what happened? Well, 03, 04, 05, 06, and into 07 were pretty good markets. Very good markets, actually, for the most part. So you didn't maybe get instant gratification. You probably felt like a dummy. You probably didn't pick the very bottom. But boy, you were awfully glad that you did buy 2, 3, 4, 5 years later. Now let's fast forward, just to give you a sense of how bad 2009 got for investors in 2008. Remember, previous low I'd ever seen was 19%. 1% in November. At that time I was banking, it wasn't going to get any lower. I went to University of Chicago. That's what they taught us there. It wasn't going to get any lower. Now, interestingly, had you used this tool like a scalpel, and the minute it got below 40% into lower risk you're buying, you didn't probably feel so good, given what happened here. And again, extremes can run longer than you think. But had you done any buying in here, even if you bought here, even if you bought here, even if you bought here, especially if you bought here, boy, you were awfully glad you did after the market rebounded and rebounded with vigor beginning in March of 2009. Interestingly, when I came here to, this was hindsight being 20/20. This is a pretty good time to buy stocks. Again, I can tell you, I didn't have many clients calling me in March of 2009 saying, Chuck, time to back up the truck. We're going to go buy some stocks. I had clients cursing me and then wanting to get out of the market because they couldn't take it anymore. But I didn't have buyers here. And that's why, again, it's so important. That's why the 401k investing model, if you're still working and you can invest where the money goes out of your paycheck automatically, those things are so important. And yeah, dollar cost averaging is great, but the only way you really take advantage of dollar cost averaging is if you're buying here or you're buying here, okay? I mean, dollar cost averaging up here you're buying, well, okay. But this is when you maximize that. But if you don't have something on autopilot, you're never going to do it. I mean, you're not going to bring yourself to buy down here. So, when I came last year, and again, this was one of the other reasons why I didn't think the market had a tremendous amount of upside, and you could have maybe a 1,500 point decline. I was talking right in here. It was November 12th. So, this thing got as high as 96%, which was the highest I had ever seen it since 1989. During my talk, we were about 89%. So, I thought at that time it was like, boy, you could have a bit higher move in the market in the short run. But typically, anytime you get into the extremes like this, you're in a little bit of borrowed time from the short-term standpoint. And lo and behold, from November, we got this was basically representing the April low, where it just creased into lower risk. It didn't really get into an outlier effect, but it did get into lower risk territory and then popped up. So where are we right now, getting back to this notion of how risky is this market? On the short run, it was 68%. I would venture to say probably after today, because this is based on yesterday, so it doesn't take into account today. So I would venture to say after today, you're probably looking at about 69 to 70% of the stocks in the New York Stock Exchange, which puts it right here at higher risk, just kind of kissing higher risk. So does that mean necessarily that tomorrow stocks have to go down on the short run, or a week from now, or even a month from now? No. As we've seen, this thing can get into higher levels, but it does give you some reason to pause to say that perhaps the probability on a shorter run basis that we could get a pretty good pullback in the market. How big of a pullback? Well, if we go back to the Dow Theory, we had a move from 9,600 to 11,400. Maybe we're going to get to 11,006, maybe 11,008, and then you're going to get a 1/3 to 2/3 correction of that, which 96 to, let's say, 11,600, that's 2,000 points. Maybe it comes down 1,400 points, so you're back down to maybe about 10,000, 10,200. So a correction down to 10,000, 10,200, would that shock me over, say, the next 3 months or so? No. I'd use it as a buying opportunity because, again, I think it'd be an opportunity to buy within a bull market. It's a pullback within a bull market. But to get a pullback like that based partly on having this kind of starting to get into higher risk territory, that wouldn't surprise me. So to kind of sum all this up, and to kind of tell you, at the end of the day, this is all great talking about charts and everything, but somehow you have to kind of put it into your investment program. I'll tell you what we're doing right now. We think the market trend is bullish. Having said that, we think there is a possibility for a pullback. But we're willing to have a fair amount of skin in the game right now. So for a client, for example, that typically we have the ability to be 100% invested in stocks for them based on a particular strategy that they may have that gives us the leeway to be 100% fully invested. Right now we're about 15 to 20% in cash. So instead of being 100% invested, we're 80, 85% in cash. Now, we're applying that percentage proportionately as well for people whose cap isn't 100% but might be 65%. So for example, if you set out your allocation in your portfolio, and because of your age and risk aversion and all those things that you do to try to figure out what that optimal asset allocation is, and it turns out that you've said, the maximum equity exposure I'm ever going to have is, say, 65%, then where we would be on that is 65% times 80% to 85%. So instead of being 65%, you're more like 50 to 55%, if that's how the math works out. So again, you're holding some money out, holding some cash, take advantage of pullbacks, but you still have plenty of skin in the game. That's kind of where we are right now. By the way, you can find this tool, that 200-day moving average. It's featured every day in Investor's Business Daily newspaper. As I said last year and the year before, I don't work for Investor's Business Daily. I don't know who I am. I don't get any money from them. But it's the one place and the only place I've ever found where they publish that stat every day. And they publish it 4 out of the 5 days on page B2, B as in boy. And on that page, you'll see a series of charts. It's the same except for Monday. On Mondays, they make you fish around for it. But on every other day, it's on page B2, and you'll see a series of charts on that page. One of the charts is the NYSE composite. And on the NYSE composite, always in the same place, they'll put the percentage here. I circled it here. The Investor's Business Daily isn't so nice to circle it for you. So you're not going to see it circled, but that's where they publish it every day. So if anybody wants to track that, the beauty of it is it's cheap. It's the cost of a daily newspaper. It's not perfect. Don't necessarily use it like a scalpel. The minute it gets into high risk, you sell, and the minute it gets into low risk, you buy. But it's a great tool to gain some perspective on a shorter market trend, say risk of the next 3 months. So, now, as I mentioned to you, the Dow Theory's primary trend is bullish. Typically, those kind of things last 18 to 24 months, sometimes as little as 12 months. One of the reasons, though, and again, this gets back to how risky is this market. By the way, when I ask you how risky is the market, what does risk mean to you? And it's an interesting question to ask yourself. Is risk really buying a stock that goes down? Or is risk really the uncertainty of not meeting a financial goal or objective? To me, that's really the crux of risk. And if you frame it that way, I think you make investment decisions that are smarter and less emotional and less reactionary. Because at the end of the day, the biggest risk of investing is that for a lot of people, the pile of money that I thought I was going to have at retirement, or the pile of money that I thought I was going to have in retirement, is not what I thought it was. That's risk. It's not I bought X, and 12 months later, it's down 10%, to me, anyway. So if you're thinking about risk in terms of a longer term, which I think is healthier, I'm reasonably upbeat about the market. And that may surprise a lot of people here. But I think there's a lot of reasons There's obviously always reasons to be bearish on stocks. There's always reasons. And I can give you a litany as much as anybody. But I think there's some really fundamental reasons to be not necessarily 1990s bullish on stocks, but to certainly see a stock market starting to return back to more normalized returns that we've had over the long run. 7%, 8%, 9% a year. Maybe not every year. Maybe it's 2%, 12%, 6%, 14%. But to average that over the next 10 years, that would not surprise me. One of the reasons, as I mentioned, I'm one of these believers in reversion to the mean. And if you go way back and look at the market, what it's done over the last 25, 28 years since I've been involved in it, we've had some really interesting patterns. At the end of 1979, for example, anybody want to take a stab at what the Dow Jones Industrial was at the end of 1979? Yes. Good guess. Yes, it's right around 800. I think it might have been, it was either 820 or 890. Okay? 820 or 890, 1979. 1989. Anybody want to guess what the Dow was? 1989. 10 years later. It was 2,700. Yeah. It was 2,700. The Dow went up roughly threefold in 10 years. That's a heck of a return. Does anybody want to guess where the Dow was at the end of 1999? It's 11,000. Yeah. Remember, we've had this 10 years of nothingness in here. 2,700 to 11,000. Stocks were going up about 18% a year on average, okay? And you wonder why we're all spoiled. Well, that's a huge, from 800 to 11,000. Somebody who believes in reversion to the mean says, we're going to get some pain in here somewhere. Okay, and we did. The decade of the 2000s, pain. 2008, 2009, lots of pain. Now, have we worked off all of that excess? I don't know. I still know that we're still 25 to 30% down from where we were in 2007. I know that. I don't think stocks are necessarily expensive when you look at kind of the things, fundamentals like P/E ratios and things like that. I think when you look at the three major engines of stock market performance, to me, those are still pretty positive. Inflation, and I did that litany on the preview. Inflation, to me, still not a problem. I know, people think, I don't think it's a problem for the next 12 months. I'm more concerned about inflation overseas, emerging market inflation, because we've become, and a lot of companies have become extremely dependent on what goes on in China, in Brazil, in India, and so forth. So that's an issue. It's not an issue in the U.S., it's more of an issue overseas. But I still feel okay about it for the next 12 months. Interest rates, I don't see them. Yeah, interest rates can't go much lower. And I don't have to tell you that if anybody has a bank CD but are they going to go much higher? I don't think they will, at least over the next 12 months, and I'm not sure that's going to be the case for the next 24. And corporate profits, which is always the primary engine, and is always kind of the $64,000 question. I have a lot of people that say, I don't know why this market is going up. I look out the window, I see 10% unemployment. We're not hiring where I'm working, and I'm glad I have a job because Joe doesn't. And, on and on and on. And I don't know why the stock market is doing what it's doing. Well, to try to take what's going on in the economy and apply it to the stock market sometimes is a fool's errand, because the stock market is anticipatory. And the economy, believe it or not, is improving. Okay, maybe not at the rate that people would like and not at the pace, but it is improving. And corporate profits have been very good. And that's one of the reasons why we've had this significant move since March of 2009. Corporate profits basically have been better, and in many cases a lot better than what expectations were. Now granted, in 2009 expectations weren't real high. We were just happy that the world wasn't ending in the beginning. But even in 2010, when expectations were higher, corporate profits keep beating that hurdle. Whether this market can sustain a bigger move upward is really, to me, it's not dependent on what happens in Ireland. Okay, it's what's going to happen with corporate profits, U.S. corporate profits. I am reasonably upbeat about that picture. The one point, too, that I want to make that also gives me some degree of optimism goes back to that question I asked you. How many people are really positive on this market? And it was pretty mixed. If investors have still a significant aversion to owning stocks, to me, that's that proverbial wall of worry that the market climbs that's positive for stocks. I get worried when everybody loves stocks and everybody's buying. I don't see that. And this is one of the things that points it to, that to me just shined. You think I ought to know what that is, right? It put a spotlight. Was this. Over the last 5 months, you've had, and I apologize for the people in the back, I'll read it off to you. Over the last 5 months, you've had a number of blue chip companies issuing debt. They're taking advantage of these ridiculously low interest rates, okay? Microsoft issued 3-year notes, 3-year bonds, they mature in 3 years, at an interest rate less than 1%. Coca-Cola did the same thing, less than 1%. Walmart issued 3-year notes. Interest rate less than 1%. IBM issued 3-year notes at a rate of 1%, okay? And they weren't raising, $6. These were all billion-plus bond offerings at 3-year notes, okay? So there were investors who wanted this stuff and wanted it bad. What kills me is people who bought the bonds and got a whopping 0.8% for the next 3 years did it. Why? Well, they have a pretty good assurance that they're going to get their full money back. And they're going to get 0.8%. So they were willing to be loaners of money to Microsoft as opposed to being an owner. Microsoft's common stock yields 2.5%. Oh, and by the way, Microsoft's dividend's probably going to go up. In fact, it is going up. I think they just raised it 14 or 15%. It's probably going to go up at least 10 to 15% next year. And the third year of the 3-year bond at Microsoft, by the way, this never goes up. You're going to get your coupon. And by the way, you're going to pay full ordinary tax rates on that. Or you could have bought the common stock that's yielding 2.5 times that, almost 3 times that. After tax return is better because dividends are tax preferenced. And oh, by the way, I would bet a huge sum of money that you're going to see the preferential rate extended and extended for all income levels. Now, I don't have any inside information or anything like that, but to me, that's a done deal. So I think you're going to continue to have preferential tax treatment for dividends for all income levels, at least over the next 12 months. I think they're probably going to punt and say, okay, we're going to extend everything for 12 months. That's kind of what I think is going to happen. So, in summary, you can buy Microsoft, get a sweet yield of 0.8%, pay full tax rate on it, or, yeah, I'm going to be taking a higher level of risk, I get that, but I'm going to get 3 times the cash flow, taxed at a preferential rate, and oh, by the way, Microsoft might even go up over the next 3 years. Now, granted, it didn't go up over the last 12 months, so who knows? But boy, when I see this happening, Coca-Cola, same thing. They issued 3-year notes, less than 1%. Coca-Cola common stock yields 2.7%. They're going to boost their dividend. Coca-Cola stock has a shot of going up. Walmart, same thing, 2.2. IBM, 1%, 1.8% common stock yield. All of them are going to raise their dividends next year. And the stock price would go up. When I see that type of aversion to stocks, to me that's unsustainable. Given the amount of cash that's out there, given the amount of cash that can come into the market, both from corporations as well as individuals, maybe that world lives for a while. But it's just, to me, it's insane. You're going to go out now and buy a 10-year treasury and get what, 2.6? 2.9? 2.95 for 10 years. Okay. Suppose I'd rather take my shot here. All things equal. Again, I understand. Different risk parameters. And, people have different risk levels, and you got to do what you got to do from an asset allocation standpoint. But, if somebody held a gun in my head and said, do you like stocks or you like bonds for the next 10 years? That's a pretty easy decision for me. So, I think we're in a situation where you could get one of those multi-year moves in the stock market. Maybe not huge. I think next year could be a pretty good year. I think stocks could be up 14, 15% next year. Third year of a presidency, typically very good. I think we're going to square away some of this uncertainty in terms of taxes, at least for 12 months. I wish they'd make it permanent. That'd be better for the market. I think corporate profits are going to be okay. So I think you could have a pretty good year next year. You might have, between now and February, you might have a little bit of rocky period, going back to our intermediate potential risk. But I think overall, 12 months from tonight, I think the market, where are we at 11.2? I think it'd be 12.5 to 12.8, maybe 13. Somebody asked me today if I thought stocks would go to 14,000 before they went back to 9,000, and I said yes. You don't need to laugh. Jeez. Admittedly, I did answer it pretty quickly too, and then I thought, did I? But I think that's the case. I think we see 14,000 before we see 9. So, if in fact this market can go on a decent run, where do I think is a sweet spot in the market then? Where do I think the really decent opportunities are in the market? Well, my firm has a tool, we call it Quadrix. It's a stock rating system that we developed about 10 years ago. And Quadrix ranks over 4,000 stocks based on more than 100 different variables for each stock. And we weight those variables and come up with a Quadrix score that's a percentile ranking. So a stock that scores 80 in Quadrix means it scores better than 80% of all the stocks in our Quadrix universe of 4,000 stocks. And we use Quadrix pretty religiously as our first important screen. We don't even consider stocks that don't meet minimum scores in Quadrix, both in overall as well as important subcategories. Like we can compute a value score for Quadrix based on the value metrics that we measure, operating momentum, price performance, etc. So we use Quadrix very heavily in the work that we do. One of the areas that I think is a sweet spot for this market going forward are kind of high-quality dividend-paying stocks. This has been a market where you can buy quality and not pay much, if any, premium for it. And I don't think that's going to last either. So when I'm looking around, I'm not saying 100% of your portfolio has to be high-quality dividend-paying stocks. But I think if you're looking where value is and where opportunities are in the stock market, I think those stocks offer some of the more interesting opportunities. This is a chart of our Quadrix model and how it's performed since we went live with it in 2000. We're pretty proud of this. The group 1 are stocks that are ranked 80 and above in Quadrix. In other words, the top quintile. And as you can see, they have significantly outperformed the stocks in the other quintiles. Now, there are periods in here when Quadrix doesn't work very well. For example, you can see this wide gap here where Quadrix was just romping and stomping, and then that blue narrowed pretty significantly as you went into 2008. Quadrix wouldn't work very well in 2008, quite honestly. Not that anything really worked too well in 2008. But if you go back to 2008, and I had a lot of people say this to me, it's like, gosh, man, the stocks that were getting beat up are the highest quality stocks. I don't get it. I'm not getting any benefit from owning quality. Well, if you go back to 2008, that was a sell-driven market. And it was a liquidity-driven market in the sense that people had to get off margin. They had to get off debt. It was just sell, sell, sell. And if it moves, sell it. If it has deep markets, higher quality, the better, because I can sell it, so I'm selling it. So you saw quality stocks really take a bit of a nosedive on a relative basis 2008. Now, one of the nice things is that's improved here significantly. Quadrix has come back nicely. And I think that trend, I'm hopeful that that's going to continue. Another thing that we look at when we're looking at dividend-paying stocks is what I call my BSD formula. I wrote a book that came out earlier this year that was published by John Wiley called The Little Book of Big Dividends. It was part of their Little Book series. And in that book, I developed what I call my BSD formula. BSD stands for Big Safe Dividends. So, it's catchy, right? Catchy. Big Safe Dividends. And what I did was I came up with a formula for picking stocks with big safe dividends. And the formula took into account these 10 individual metrics, okay? I'm not going to go through all these metrics with you, but these were the metrics. We didn't back test our way into this formula, by the way. We sat down, my staff and our analysts, and said, what do we think makes the most sense when you're trying to pick dividend stocks? What metrics do you want to look at? Well, you want to look at payout ratio. What's the payout ratio? Well, if any of you invest in dividend stocks, if you only know what a payout ratio is, you're going to be way ahead of the game. The payout ratio is what? It's the percentage of profits that you're paying out in dividends. So if a company makes $2 per share in profit and it pays out $1 per share in dividends, the payout ratio is 50%. Obviously, the closer that payout ratio gets to 100%, means what? Well, it means that there's a whole lot of cushion there if the company has bad earnings, and there certainly isn't a cushion there for them to grow the dividend. Conversely, if a company's only paying out 25% or 20% of their profits in the form of dividends, because ultimately, at the end of the day, that's where the dividends come from. Yeah, companies can borrow money to pay the dividend, which is stupid, but they'll do it. And yeah, maybe they keep that going, but at some point, if the profits aren't there, the company's not going to pay the dividend. So, we're looking at payout ratios. We start to get nervous anytime the payout ratio on non-REITs and non-utility stocks starts to get north of 60%. We get real nervous if it's north of 85%. We look at things as interest coverage, dividend yield, 6-month relative strength. 6-month relative strength is basically the relative price performance of the stock versus the rest of the stocks in the universe. Now, somebody may go, why do you care about dividends? What's that have to do with the performance of the stock? Well, go back to 2008. All of you probably own stocks that probably cut their dividends because 2008 was one of the worst years ever. Well, what happened? The stock price went down a heck of a lot sooner than the company actually cut their dividend. The stock price was basically telling you that they were going to cut their dividend. The other thing it was telling you was all of a sudden your stock was yielding 11.5%. And that wasn't because it was a great stock. It was because they were going to cut their dividend. So we look at these things, we factor them in, and we rate them, and we come up with a formula. And it's a percentile ranking like our Quadric system. One of the strategies my firm offers is something called our dividend quant strategy. And basically, it's for people who want dividend-paying stocks to generate some cash flow in a portfolio. And we marry our Quadric system, which looks at the total return potential of a stock, with our BSD formula, which looks at the dividend potential of the stock and the dividend growth potential. And we run a quantitative model. And we only pick stocks that score 80 and above in Quadrics, in the top quintile, 80 and above in our BSD formula, with some other overlays and filters there to really narrow down the universe to what we think are the best stocks for total return that pay dividends, where you can see those dividends grow. Now, the next slide will have those names. So this is when you wake up. Pull out a pen and write down the names. So here are companies that score very well on this kind of dual system that we have. Good Quadric scores, 80 and above. Good BSD scores, 80 and above. Some other filters that we use, etc. I'm not going to go through all these stocks in detail. Some of the ones that I do want to highlight are, why, there's Microsoft again. Yeah, I got to get it right sometime, right? It's down 14%. Hopefully it can come back. One stock I want to mention, because it's not a household name. A lot of these names are probably familiar. Alliance Resource is a coal limited partnership. I generally don't do much in the limited partnership area. But Alliance Resource scores quite well in both our Quadrics and our BSD formula. The yield on the stock, actually the yield on the limited partnership is 5.4%. So it's a nice yielder. Now that's a limited partnership, which means anybody who has owned a limited partnership in the past knows that you don't get a 1099, you get K1. So if you've ever filled out a K1, you'll probably curse me if you buy that and get your K1. But again, we don't limited partnership. Some of the MLPs in that area I think are a tad pricey. This is one that scores pretty well, Alliance Resource. You got Abbott Laboratories, Chevron, Microsoft, Aflac. Aflac. We like the stock quite a bit, actually. Aflac, you might get a pretty good chance to buy that stock here as well. Aflac, it's the insurance company, supplemental insurance. Actually, you know, we're so familiar with the duck. Does anybody really know what their primary business is? Yeah, they sell supplemental cancer insurance in Japan. That's their primary business. They have U.S. business as well, but that's where they cut their nut. They're growing their U.S. business too. You know, as is the case with a lot of insurers, they have a lot of bonds on their books, and these guys have a fair amount of some European bank bonds. So there's a risk there. And generally, when you have flare-ups in the Eurozone, Aflac gets beat up periodically. I think their exposure there is very manageable, and I think if you get an opportunity, that stock dips because some things start to worsen in Europe and it starts to take it out on Aflac, I'd buy the stock. You have IBM, CSX, the railroad. Texas Instruments is a stock that I like quite a bit right now, actually. It's a tech stock. Interestingly, people don't think of tech stocks as dividend investments. But that's really changed. On this list alone, you've got Microsoft, you've got IBM, you've got Texas Instruments. And I can name a couple of others. Intel's right now yields 3.5%, a stock that we like quite a bit. The one that I wanted to mention was Nu Skin Enterprises, which isn't really a household name. Nu Skin, symbols NUS, yields about 1.6, 1.7%. Not a huge yield. But a yield that's certainly better than, you know, it's better than a 12-month CD or a 12-month Treasury, even a 2-year Treasury. They're a kind of an Avon of anti-aging skin products, which sounds, you know, like, oh, geez. You know, they have 700,000 reps, but they're doing it primarily overseas, in Asia, in China. They're knocking the cover off the ball in terms of their profit growth, 15 to 20% this year at least. It'll be 15% at least next year. Stock trades at about maybe 13 times next year's earnings. It's a smaller stock. Market cap, I think, what do I have it here? Market cap is about $2 billion. So it's more small to mid cap. A lot of these are big stocks, but I put it on here just to kind of give you a different flavor that there are smaller companies out there that offer dividends, growing dividends, decent yields, good total return. The three on the bottom that you can't see in the back, one is Rogers Communications. That's a Canadian-based company. That's one of their premier broadcasters, media companies up there, yields 3.5%. Baxter International's next to last, the healthcare company, and then finally Travelers, the insurance company. Again, the common thread, good dividend investments. They score well in our models. We like their total return potential in stocks that we think all represent buys. These are attractive dividend payers among foreign companies. Okay? All of the companies on here pay dividends. All of their ADRs trade on the U.S. stock exchanges. So an ADR basically, as you know, it's an American Depository Receipt, which basically is a vehicle that a foreign company creates to trade their stock on U.S. stock exchanges. So, you know, for example, there's that name again, Novo Nordisk. It's a Denmark-based company, okay? Novo Nordisk trades on the U.S. stock exchange. It's its ADR, actually, that trades on the New York Stock Exchange. And ADRs are created so you can buy and sell the stock in U.S. dollars, you get dividends in U.S. dollars, et cetera. So it's just like buying a common stock, and it has a ticker symbol and the whole 9 yards. It just happens to be a foreign company. And all these trade on the New York Stock Exchange, and they represent companies throughout the world, literally. All of them pay dividends. I like all of them. I think all of them are buys right now. The other common thread here, and this gets to this notion that's near and dear to my heart, they all offer direct purchase plans. Direct purchase plans are those companies that allow investors to buy stock directly from the company or an agent of the company, what's called a transfer agent. They're a form of a dividend reinvestment plan. And most people think of U.S. companies that offer them. And actually, on this list, many of these offer them. Chevron, for example, – Microsoft, Aflac, IBM, CSX, Texas Instruments. All of those companies right there allow any investor in this room to buy their first share in every share of stock directly from the company. It's very easy. They all have toll-free numbers. You can go online to their websites, go to their shareholder services area. There's a toll-free number. You call the toll-free number. You get an application and enrollment form. You read the brochure. It tells you all the details of the plan, what the minimum and maximum investments are, whether they're fees, etc. And you can buy them. And in many cases, the most you'll pay for the initial minimum investment is $1,000. In some cases, it's $250. After you make that minimum, you don't have to make another investment if you don't want to. If you want to, in many cases, it's as little as 50 or $100. So these companies, Abbott has a traditional drip where you need to have one share of stock before you can enroll in the plan. But Chevron, Microsoft, Aflac, IBM, CSX, Texas Instruments all have direct purchase. You can make your initial investment directly. Same goes with all of these companies. You can make your initial investment in all of these companies. And actually, a lot of these companies are probably familiar to you, even though you don't know their name very well. I mentioned Novo Nordisk. They're the insulin treatment. You've got Fresenius Medical, kidney dialysis. Some of you, hopefully not, but there may be somebody you know who gets their dialysis at a Fresenius facility. China Mobile, largest cellular telephone network in the world. AstraZeneca, Healthcare, Novartis, Pharmaceuticals, PetroChina, Chinese oil company. Smith & Nephew is an orthopedic implant company in the United Kingdom. And Unilever is the consumer products company also based in the United Kingdom. So, again, all of these companies you can buy directly, all of them attractive dividend payers. Keep in mind, when you do buy foreign stocks for their dividends, there's a couple of wrinkles. One, foreign stocks typically only pay their dividends semi-annually or annually, whereas in the US they pay them quarterly, 4 times a year. So keep that in mind. Also, there may be withholding on taxes, but you can claim that back in by filing a form to do that. I've owned foreign stocks. It's not that big a deal. Don't let the tax weirdness keep you out if you like a stock that's foreign stock. Finally, I mentioned my book, The Little Book of Big Dividends. It's in bookstores. But more importantly, on the bottom here is a website that's a companion to the book. It's www.bigsafedividends.com. bigsafedividends.com. The nice thing about that website, and I'm biased, we did it, but it's a very simple website. It doesn't have a ton of stuff on it, but what it does have is we've gone through and done the math for you. And on a weekly basis, we give you the BSD score and Quadric scores for over, I think it's all the dividend-paying stocks in the S&P 1500. So for all the S&P 1500 stocks that pay dividends, you can go to this website. It's free. I think you have to register, but it's free. And then on a weekly basis, we update and give you the BSD score and the Quadric score. So you can kind of use it if you're trolling around for dividend-paying stocks. That's my presentation to you. Thank you for coming this evening. I'd be glad to answer any questions anybody has. I have a question right here. Wait till we get the mic to you, sir.
Thank you for a wonderful presentation. A few weeks ago, the Fed dumped $600 billion into the economy, and the Germans and the Chinese were very upset. Will the dollar continue to be the world standard? If it does not, what will that do to the American economy? You know,
I don't get too bent out of shape with the dollar being really, really weak. I mean, to me, it's just the pendulum. And you saw it, the dollar, last time when I came here, November 12th, I think the dollar versus the euro at that time was about $1.50. Today, it's about $1.29. So the dollar actually, believe it or not, as much as you hear about the dollar going to heck in a handbasket over the last 12 months, at least against the euro, the dollar's actually up this year. I think it's about 8 or 9%. Now, against the yen, it's probably down a little bit, probably single digits. Against some of the other currencies, it's up and it's down. I don't get too bent out of shape over that. I'm not too worried about that. There may be smarter people out there that say I'm an idiot. I can tell you, one of the things that's been driving, profits for multinational corporations has been the weak dollar. So, as much as people say we need a stronger dollar, I think there's a middle ground in there that benefits everybody, especially from a stock market perspective. So there seems to be a lot of currency battles going on now. Should China all that. To me, the dollar where it is right now, purely from an investment and stock market standpoint, I don't see that being a real negative, to tell you the truth.
Thank you.
Yes. Yes.
Where do you see this enormous deficit affecting the stock market?
Well, the stock market is anticipatory. So I don't think the news, this is all new, this is big news to the stock market, what we have now. And the market moves on trends. It doesn't necessarily move on absolutes. It moves on trends and it moves on expectations. So I think if there is a willingness to at least try to harness this, I look at that as something that could be net positive for stocks. And that would be one of the things that might go into a surprisingly more bullish scenario. The jury's still out. I don't care if you're Republicans or Democrats. The fact is, everybody seems to like to spend money as a politician. I probably just got myself in trouble saying that here, didn't I? But that tends to be the fact, so we'll have to wait and see. But I think there's something brewing out there. And again, we got a huge absolute number. But again, the market moves, it's more reflective of trends. It's the same thing that, when a company comes out and they lost $3 a share and the stock goes up 10%, and you sit there and scratch your head. Well, the reason it did that, everybody thought they were going to lose $6 per share, and that's how stock markets behave. So if there is a sense that something is brewing, that the trend is favorable, I think the market will respond well to that. Yes, and right behind you there.
Well, we all think inflation is in the future. How are you feeling about intermediate to long-term investments in gold equivalents such as the EFT or gold mining stocks?
We have one gold mining stock in a portfolio we like a lot is Newmont Mining. The symbol's NEM, I believe. And that's our favorite gold mining stock. I have to tell you, though, my track record on picking gold has been pretty abysmal. I thought gold was high 12 months ago. Shoot, I thought it was high 24 months ago. So I'm probably not the best person. I do think it's become a bit of a crowded trade. The one thing that has helped it, though, and you've seen this, the democratization, I can never say that word, the democratization, I did, thank you, of some investments has really put a jolt into those investments. It used to be if you like gold, you had two options. You bought a gold mining stock, or somehow you bought Cougarans from who knows who, and now you have this GLD, that ETF. And because now you have a tool that anybody in this room can go out and buy gold as easy as buying any stock with a click of a button, you've created this kind of frictionless market to have money going into an asset class like that, whether it's gold. And I think that's why you're seeing commodities in general correlating much more tightly with common stocks than we used to. It used to be the old saw was, you buy commodities, because they're not necessarily correlated assets. But if you look at the correlations between commodities and gold and stocks, they're really tight. And one of the reasons they're really tight is people are buying them the same way they buy stocks. And there's vehicles now that you can do that. I have no problem putting 5% to 8% of a portfolio in gold/commodities. Again, as a place to try to take advantage of some of these trends. The problem is, my experience with people who like gold is they don't buy 5 to 8 to 10%. They buy 150%. And I'd be a little leery of doing that right now, quite honestly. It just seems to me that it's now, having said, I would have said the same thing 12 months ago, and I would have said the same thing 24 months ago, and I'd be standing up here looking stupid, and 12 months from now I may look stupid too. But to me it just seems, I look at it this way. If somebody said, where is the best opportunity for your dollar? Is it gold or is it common stocks for the next 24 months? I think it's common stocks. But having said that, to have a small portion in gold, I don't have a problem with that. And you know, the GLD is an easy way to do it. I'm starting to get a little nervous about just the amount of money that's being. It's the second largest ETF now in terms of assets. I think it has 50 or 60 billion dollars in there. And that's ramped up really fast, and you know, like any other asset class, the stuff that gets ramped up really fast can come down really fast.
We have time for one more question.
One more? In the back there? Who are you pointing at? Oh, okay.
There's been a lot of money that's moved into the bonds everywhere, municipals, corporate bonds. Two questions. What is your feeling on the bond situation, and is there a bond bubble coming?
Bonds are one of those tough asset classes because, I mean, if they're going to have less volatility than stocks. So if you're trying to sit there and allocate and develop a prudent portfolio strategy, you know, I don't like bonds particularly, but if I have, you know, a 75-year-old who has an investment time horizon and it dictates that their portfolio, I'm not going to put them 100% in stocks no matter how much I like stocks. So I still got to find places in the bond market. We're kind of tilting the short end because we're chicken, and we're tilting corporates. That's kind of my feeling on that. Now, you know, we're buying bonds not so much because we think you're going to get rich buying them. I don't think that. I think it's try to dampen the volatility of a portfolio. But again, we're staying short. Our favorite short-term bond fund is the Vanguard Short-Term Investment Grade Bond Fund. The VFSTX is the symbol. VFSTX. And in terms of corporates, you know, short, a little bit of intermediate, but we're not going real long. We're not doing much in long term right now. So.
Is there a bubble coming or not?
Well, you know, yeah, I guess I didn't answer that, did I? I don't know about a bubble. I don't know about a bubble. Could bonds actually go down in a year? Sure. Yeah. I mean, it doesn't happen often, but it happened in 2008. It happened in early 1990s. Yeah, you could have a down year. And I think if you had a stock market, you know, next year, if I'm right and stocks are up 14 or 15%, yeah, you might see bonds up 1 to 2%, maybe down 1 or 2%. I don't think you're going to get it like we got in 2008, where you had high yield bonds are down 30%. But yeah, I mean, in terms of what a bubble popping in the bond market would be, you could have a down market.
Please join me in thanking our speaker.
Thank you.